Cool. Looks like it's all set up. Just gonna do one last thing here quick. Perfect. All right. Cool. Okay, everything's set up. So, I have been on a cruise over the last week, so I haven't had really a chance to discuss the investments and where things are. It's been a rocky week. At one point, I think I was down as much as $2,000 on my $46,000 portfolio. Really made me question about selling things off and going down that path, but staying true for right now. I have another 2,000 in the hopper ready to go for Monday. The portfolio right now is at 1,200 back. So let's talk about that. And why I was thinking about selling in the first place. So the max that you can roll forward in any given year against your taxable income is $3,000. So let's say I lose $3,000. Then, and I know I'm going to invest long term, I want to use that as an opportunity to do what's called tax harvesting and offload to gain a tax benefit today and move the positions into a vehicle that would better maybe suit me long term. Now, because it is to bridge the gap of retirement from when I say retire before I'm at age to pull out a 401k, I need income to be able to bridge that gap. So what I'm doing is creating something that's going to produce dividends to do such. So here's where the dividends are sitting as of today. We've almost got a comma on the dividends for the year. Pushing 959 is the estimated dividends for the year, which is why when I sit here and talk about being $1,000 in the hole right now, frankly, who gives a shit? I mean, dividends are going to make up for it right now. And I've got some fun stuff about some investments that you guys might want to hear in a minute, because I put together something that I was looking at doing. And it's going to really open your eyes to like min-maxing and like where things are right now. So I'm going to jump over to that here in a second. If anyone has any questions about my portfolio, I'm going to just scroll through this so you can see the ticker of everything that I have. Well, I don't know if I can get all of them in there. Got very close to being able to get them all in there. Anywho, you'll notice they're all Vanguard funds, and all the Vanguard funds are different sectors or growth. So small cap, large cap, mid cap. I got all value, blend, and growth for all of them. And then I have all 9 sectors, and then I've got 3 sets of bonds, and it's probably easier to just show you on this. Here we go. This is way easier to show you on. So all 9 sectors, they're holding 20,000, just short of 21,000 of the portfolio. And then for the rest of the investments, I've got bonds for 3. I've got large cap, blend, growth, value, mid cap, blend, value, small cap, blend, value, and then some international stock as well. So that's how this mix looks. The goal is to have 5% in each stock. You can see it's starting to get very tight. So my buying shopping list for Monday looks a little something like this. Very tame. Little international stock, 1 large cap, blend, 1 large cap growth. Both of those are close to $500 a share. A mid cap, a small cap, a lot of international bonds, 1 finance, and 1 utility. And that'll round off at 50. Is that going to get me to 50? No, I will be 1 week short of 50,000 invested. So it's been a long haul. I've stuck to it. 2,000 a week. It's tough to watch the dip that's going on right now, but let's talk about the dip for a second. So I have this little thing called an RNO. So in finance terms, I call that risk and opportunities. So for people that have heard that before, that's what an RNO is. And so when I run an RNO on the portfolio, I've got on top here what I call my wish list companies. And then I've got, here, let me just close this a little bit so you can see a little bit of the data on the far right. So, am I going to be able to, there we go. Okay. Sorry if it's really small, but let's talk through it for a second. So my current mix is down here on the bottom. These are all 20 stocks that I have. So I'm going to just zoom up here so you can see all of my current mix, if you will. This is going to be, again, all the sectors, large cap, mid cap, small cap, a bunch of bonds and some international stuff. Really, really diversified. One thing I want to show you is this. So the way this thing is going across the top is the statistics, low, high, and the current price. So this is the 52-week low, this is the 52-week high, and this is the price right now today. And then the percents over here say, okay, so this bond market is up 1% from its all-time high, or sorry, from its all-time low for the 52-week, and it's down 4% from the all-time high. And then what I did is I came over here and I said if I took my current investment portfolio, which is 44,000, and it'll be 46 on the next swing here, how would that look if I invested everything at the 52-week low? So I was the best at timing the market. Here's what I would have done. I would have ended up turning my portfolio, it would have made about a $5,000 profit. You can see this higher lower over here is saying where would it be? And it's pretty, status quo. Now, here's what's really interesting about the way I'm investing, and you guys will probably hopefully understand this for those that are tuning in, why I do what I do. So, from the 52-week high, I am actually, whoops, why is this not doing what I want it to do? That's a problem. Sorry, guys. Dumb formula problems. So, if I was perfect, it would have been $9,000 is what I would have made from the 52-week low. Now, from the all-time high, we know how the stock market's bumpy and everything, and you hear all this shit in the news. Guess what? My portfolio is up $20 from the all-time high. That's how good this portfolio is. So everyone that's talking about the market being down, we're good. We're good. Now, the problem is when I started investing was I brought in these ugly guys, the small cap, small cap and mid cap. You guys better remember when I got to about 40,000, I started buying in small cap and mid cap. They're the ones that are getting absolutely whacked right now. So the reason my portfolio is down is actually because of the small cap and mid cap. Had I bought them evenly, like I have been doing with all the other sectors, I wouldn't be in such a negative right now. So the cool thing is the portfolio I have is it could be up about 10,000 just under from the 52-week low if I was perfect. And if I bought at the all-time high and just did a lump sum buy, I would be up $20 type of thing across all the portfolio, which is kind of unique. So it's cool to see that. That's why we diversify. That's why we do what we do. Now, which portfolios are actually getting whacked? Well, let's talk about that. So, consumer discretionary, getting destroyed. Small cap, 15% down from 52-week high. The info tech, down 13%. So the tech sector is getting whacked. The industrial sector is getting whacked. Communication sector, whacked. Growth sector, whacked. Those are the sectors that are really pulling back from their 52-week high. Now, I'm going to show you that same math problem with my what I call wish list of companies that I am watching right now very heavily. And I think the goal is once I surpass the 50,000 invested, I'm going to take a chill pill on the diversity. Or diversity. Is it diversity? I don't know. Anyways, I'm going to take a... No. What is the word for that? Diversification? Yeah, there we go. Diversification. I'm going to take a break from doing that, and then I'm going to start looking at REITs, so dividend investments, as well as stocks and companies that I feel that are on what I would like to call sale. And that's, I think, where the majority of the finance chat, where people really like to talk. Okay. Just got done with the workout. Got to get the amino acids going. Anywho. Okay, so let's talk about the companies that are, what I would say, looking juicy right now. Or that I am personally interested in. I use their products, you name it. All right, Apple, number one. They're up 33% from their all-time low. 52-week. Let's just talk 52-week low. Up 33%, down 16% from their all-time high. They're trading at $218 as of Friday. So they're down a total of about $40 a share. That's kind of how this is working here. So let's keep going. Google. They're up 11% from their low, down 20% from their high. Meta, up 44% from their low, but still down 20% from their high. And you can just see the tech companies are kind of consistent with that. Amazon, up 30% from the low as of today, down 20% from the high. So again, everyone that's out in the news, creating clickbait, causing problems, this is not sustainable. Apple was up 52% from their 52-week low. That makes no goddamn sense. That makes no sense at all. Alphabet up 30%. Meta was up 60%. 60. This is going to happen. This correction was going to happen. Blame it on tariffs. Blame it on the news that you hear. Common sense when investing. The CAGR on, which is the compounded adjusted growth rate on stocks, S&P 500, is about 10%. When adjusted for inflation, it's a little lower than that. It's like 8-9% per year. So think about that. If in 1 year Meta's rocking a 60%, that means for the next 5 years, you will lose money. That's what this is trying to say. So like if you're wondering, like, is now a good time to buy? Well, we're still up 44% from their all-time low for Meta. Amazon's up 30%, Costco's up 30%, but down 16%. Delta Airlines, this is one of my hot ones, up 25% from their low, down 33%, sitting at 47. The ones that I'm going to call my hot ones, I'm going to actually look through their 10Ks, maybe in some future finance chats, and we can talk about like what's the health of their balance sheet look like and how's their income statement looking. Walmart is a staple. Tesla, this one is a roller coaster. They're still up 80%. 80% from their 52-week low as of today. So if you were a genius and invested at the right time, you would have almost doubled your money in the last year on Tesla, even with a 50% reduction from where their all-time high. So anytime you invest in a Tesla, Nvidia, technology, be ready for a roller coaster, because all it takes is some news to come out. Next thing you know, everything just plummets. So, American Express. I use it. I've got multiple cards with them. I love their product. I love when I call them. They got a special line that I get to talk to. It's just I've had nothing but class with American Express. Up 26% from the low, down 17% from the high. Target. Now this is one that's very, very interesting because I've been hearing a lot about this one. They're getting whacked in the news. They're struggling with all sorts of other things going on. They are almost at their 52-week low. They're barely above their 52-week low. 2% above, $2 a share or higher. They're down almost 43%. Target is actually getting hurt more than Tesla. Think about that for a second. And they're not even in the news. They're not in the news. And they're hurting worse. They're getting absolutely hurt. And we use Target all the time. So I hope they get their stuff together because we go to Target quite often. I should get a red card, speaking of that. I got to think about that. 5% cash back is nice. Anyways, Johnson & Johnson. So this conglomerate giant who's in all over the place. They have a very healthy dividend, which is why I like them. And this is where you're going to notice something. So in the stock market, people like to run up, down, left, right, all over the place. And when times are risky, people pull out and put cash into things. When the interest rates are high, they'll put monies in CDs, money markets, things that are short-term risk while they're waiting for the waves to die down just enough to jump in. And then when it's ready, they'll come in. Now, if interest rates are low, time and time again, I have noticed in the market that people run to dividend-style stocks if they're not going to go into like gold or silver or those type of tangibles. Now Bitcoin's obviously in the play too, but so Johnson & Johnson, heavy dividend, very nice. What you'll notice is they're up 16%, so they don't have a sexy up from a 52-week low, but they're only down 4% from their 52-week high. So it's kind of interesting to think about that. People are definitely flocking to dividend stocks right now. It's very clear to me because I've ran through quite a few of these companies with dividends and I'm seeing less impacts on them because they're cash cows. Coca-Cola, another great example of that. They're up 20% from their 52-week low, down 6.6% from their 52-week high. Their dividend's not as cool as Johnson & Johnson's, if I recall. I could be wrong, but again, you'll notice nothing crazy with these stocks. Very tame. Up 20% though, year over year, pretty much year over year. And then this last one, I don't really know much about this company, but I was listening to some people that are doing like valuations right now, and they threw this company out here, and it's pretty damn appealing to me. I just need to learn more about it. At Core, Incorp, I don't know. They do something, I think, with semiconductors, I want to say. I actually don't recall. Anyways, they're up 12% from their low and down 68% from their high. That right now is the hottest of the down from the 52-week lows. So what I did with my stocks, now let's do that with these stocks. So let's say I invested the same amount of money in the individual stocks, okay? This is where it makes me want to vomit, barf, and puke all over the damn place. But this is why I don't invest in this, because it's a roller coaster. So had I invested the same 44 that's down here, but I split it evenly across these companies, I would be at $57,000, whereas down here it was worth, I'll scroll up, $47,000. So investing in individual stocks right now, if you were catching the low, what you'll notice is that individual stocks will outperform ETFs if you have the right ones, by far. Now, this is where my portfolio will show you when times are shaky, when the grounds are interestingly uncertain. This is why you get in ETFs and you have ETFs. If I was investing in all these companies at their 52-week high, I would have lost $19,000. Whereas on my portfolio, I would have gained $20. It's kind of interesting. So, it's kind of interesting to just know that and be aware of it, because ETFs are great vehicles when things are shaky, things are unknown. And now where I'm at personally is I was very close when I was down $2,000. I was very close to just dumping all my ETFs and going after these companies right here, these 13. I think I had it at 10. I wasn't going to include this one, and Tesla's a new one. I didn't have that on the list. And then I also didn't have, there was one other one I wasn't going to use. I don't know. Anyways, I think it was Costco. I like Costco, but I don't like them enough to invest in them. Anyways, as it stands right now, if I were to buy in and these companies get back to their 52-week high, if they do, it will be the easiest $19,000 I've ever made in my life. I will tell you that right now. So this is why people invest in things that are diversified while the ground is shaking. And then what they do is they know better than anyone else how to get in on these, say, 10 stocks, whatever they might be. And so they hoard cash. You might hear Warren Buffett like hoarding cash, XYZ hoarding cash. What that means is they're waiting for a sweet deal on Coca-Cola or whoever. I don't know what their strategies are. I haven't really read much of them. But what I'll tell you is that this is how these people maximize the hell out of their money, because doing ETFs are 50% as effective if you know how to get the ins and outs. So like a great example would be, let's say you put these put call options on things. I'm not going to get into what put call options are, but for right now. But let's say you know that as soon as Apple breaks like a 50% threshold year over year, you start putting in puts that it's going to drop to protect yourself. Is it sell? Whatever. Anyways, you get yourself into a position so that, and that's where these guys are really good, and I don't understand this stuff enough to speak on it because I haven't dabbled in it enough yet, but they'll protect themselves when a threshold gets high enough. So like when Google was at 30%, maybe it's uncommon for them to ever break 35% on a year over year. So maybe at that point, when it hit 30, you start selling options or puts to protect yourself. And these people are so damn good at it that that's why these guys are making so much money. And you know, the sad part is they're making money off the people that are selling. How do I want to say this? So let's say during COVID, you sold your 401k or you sold investments during COVID, and didn't buy back when it started to come back up. They're the ones that now take that from you. So people that really understand this, the stock market doesn't go down, it goes up. Individual companies can fail and go bankrupt, which I personally think these ETFs have been such an amazing vehicle for people to just kind of dabble on their own. And it has a long-term play. Now, it's not sexy. It's not going to give you a Bitcoin return, but it's going to give you a return. And it has. It's proven it forever. Ever and ever and ever. It's never not. So that's kind of what I want to talk about today. And I think and hope Some of you guys picked some cool information up from me today on this. If anyone's got any questions or wants to talk about anything, let me know. This is where my mind's at today. Could change tomorrow, but I need to stay the course. We've got about a $1,200 loss right now. It's not enough to tax harvest. It's not worth it. We got some dividends coming. That'll help a little bit. I've already earned some dividends, but now this will be the first quarter where we get some nice dividends to come back. So, Beans the chat is pretty quiet today. If you guys enjoyed yourself, I see you a couple out there. Smash that like button. I'll try to be a little bit more consistent. I'm getting better at this, but yeah. Anywho, I'm gonna do my other channel here in a little bit. I'm gonna shut this down, and thanks for those that tuned in and those that tuned in after the live. Appreciate you stopping in and